Cameron, it is the case, and I think it's a good reminder what Goolsbee had to say, which is it's inflation that is in the mandate, and it is the target of their policy right now. It's not we need to get unemployment to a certain level. We need the economy to slow to a certain point. Financial conditions have to be to a certain level of tightness. Those are all the tools. Those are not the jobs. So do you think that there's a shot the economy can have this more benign outcome?
Well, certainly, but I think it really does depend on the path of services inflation, because Goolsbee called out goods inflation is needing to see more progress on that front, but that's been in disinflation for 18 months from durable goods. So we've already seen progress on that. It's the services inflation that remains so sticky, and why the Fed keeps bringing up the labor market is something that they need to watch, because we still see wages being very elevated. Yes, they're a little bit off their highs, but we saw in the average hourly earnings today, that was the source of upside surprise. So how much does the tighter labor market and higher wages feed into that services inflation and keep them from truly achieving the entirety of their 2% goal?
Cameron, I'll just give you real quickly the Goolsbee response to that, because I asked him that, and he was talking about the work week as a whole, which is kind of down from where it was. And as you know, the amount that people take home is the hours worked times the wage. And if one goes down a little bit and the other goes up, you kind of end up sort of in the flattest area. That's his response to the inflationary impulse from the wage numbers.
Although I do think, Steve, that what Cameron said and all that we've been talking about does get to this idea of we take some heart in the resilience of the economy. And Liesman, I love your thought on this, but the resilience of the economy is also the thing that keeps certain factors sticky, whether it is wage growth or it is some of these measures of inflation, and therefore it keeps the Fed in the game looking to do perhaps more versus less. So is this just elongating the process, Liesman, or do you actually think that that we can get to some kind of really favorable equilibrium at some point soon?
Well, I do think it's elongating the process, and nobody wants a recession or any kind of contraction in economic growth. But frankly, one that gets pushed further out, possibly into 2024, I don't think that that's a more bullish environment for the stock market. I think weakness sooner rather than later allows the Fed not to pivot to rate cuts, but to move into pause mode. So I actually think not that we're cheering for weaker economic numbers, but that's the better scenario from a market perspective than a push out into 2024.
Yeah, Cameron, it seems as if this market has required, and it's not that atypical, but it's very stark this year. It's required these scares along the way, people to get worried about something and have a little bit of a concentration of fear and selling intensive, and then get a little bit of relief when it doesn't get so bad. So we've been riding that for a while. I wonder if you think that brings us to a place where, we're not able to necessarily find the next thing to climb as a wall of worry.
Yeah, the market has certainly shrugged off a lot. And one of the things that it has shrugged off is the impact on better data to the pricing of Fed rate cuts in 2023. Because just a couple of months ago, there was a pretty aggressive pivot priced into the back half of the year, which has been now effectively completely priced out as data hasn't supported the Fed moving to an easy stance. But as that has been priced out, you've seen the upward pressure on yields, and yet equity markets have completely ignored the message from yields and really continue to see really sharp valuation expansion in the face of higher nominal and, as Liesman pointed out earlier, real yields. And to see the real yield for the 10-year go to a new year-to-date high of nearly 1.8% today and have the NASDAQ and growth stocks lead the market higher just is a great example of how much those parts of the market have ignored the message from yields.
Are they ignoring the message, or are they feeding off of something else out there besides just the math of sort of the real cost of money, do you think?
I think it's a little bit of both. So the message from yields may be that the Fed itself and the market still has cuts priced into 2024. So what's a couple extra months of higher interest rates before you get the eventual pivot? But to your point on the second hand is that there really are other things driving this market higher. It's the optimism around AI and what that could mean for earnings. We haven't seen that shown up in earnings estimates yet. The Russell 1000 growth earnings have only been revised up by about 3% over the past couple of months. And usually those do lag, but we'll really need to see those earnings estimates be revised higher to justify these kind of valuations, which really do price in a fair amount of good news from out years into today's levels. Mm-hmm.